All right, hello and welcome to each and every one of you to today's DVD. Let me take a moment to introduce myself. My name is Doug Rumer. I'm the lead trader and founder at thelincolnlist.com. I'm also a 20-year trading veteran, 15 of which I have been doing professionally. And we got a lot of great stuff that we're going to be talking about in today's DVD. Now, it doesn't make a difference what level that you are at right now with your trading. Maybe you're somebody who has been experiencing some success and you're just trying to gain a little extra edge. Or maybe you're that hobbyist amateur trader that's been bounced around from system to system, that's had a couple of great months or maybe a couple of good years followed by a couple of bad months or bad years. You just can't seem to gain any consistency and you're ready to take that next step in your trading career. Or maybe you're just that new trader out there that just wants to explore whether trading is for you and you just want to get the right type of foundation. No matter what level you are at, we are going to cover some great topics that's going to help each and every one of you. And I am for sure that after I share my 20 years of trading experience with you, not all of it obviously in this short DVD, but the most important things that your trading should improve after you watch this DVD, or at least point you in the right direction and get you on the path to success. Now, before I start though, I would like to say I don't know how you came in contact with this DVD. Mainly, it probably came through a social media channel such as YouTube, Twitter, Instagram, or something like that. I'm going to post some links up here that if you're active on social media, make sure to subscribe or follow the Lincoln List on all of its social media channels. We're constantly putting out regular educational content and things like our whiteboard lessons. We post chart setups. We do market recaps and reviews, all which are free. So if you do not subscribe to any of our channels, here they are. The link is above. Make sure that you follow. Now, the things I want to focus here on today, I know a lot of you are probably thinking, where do I start? Or how do I get started? Or what is it that you have to do to become a successful trader? And so many people think there was this light bulb moment. Now, I don't have forever to tell my story of how I started with trading, but if you remember from the beginning, I said I've been trading for 20 years, 15 of which professional. So it was that very first 5 years that was somewhat of a disaster for me. So when I tell my story to people, they want to know, how did you lose so much money? Maybe some of you saw a webinar I did a while ago, how in those early years I blew up a couple accounts before I became successful. What was there? Was there a light bulb moment? What was the moment that you knew that you were no longer going to be an amateur and you were going to be a professional? Well, I'm here to say, and I think I vouch for most professional traders, that there's not this one light bulb moment that goes off and you say, okay, that's it. That's what made the difference. Like you can point to one thing. And that goes for like strategies, because in my early career, I was thinking, okay, this one strategy is what's going to make me successful. This one trading indicator is what's going to make me successful. This one thing that I do is going to change everything. And I think I speak again for everyone who is a professional trader that that's just not how it works. What it is, it's a combination of the small things that you do and that you perfect and you build the right kind of trading foundation. That's what ultimately makes the difference as to whether or not that you're successful. And successful, when I say successful, I obviously mean successful for the long term, because anybody can experience a good trading year. Maybe it's a great bull market and you're just throwing darts like I obviously was in 99 and 2000, but then the market changes and you're not quite ready for that. So when I'm talking about consistency and the things that I want to focus on in this DVD is building the right kind of trading components for you. The kind that no matter what strategy you use, no matter what financial instrument you choose to trade, whether it's foreign currencies, options, stocks, binary options, cryptocurrencies, makes no difference. You will have to have these foundational components in your toolkit or you stand no chance. And I mean no chance whatsoever of sustaining any long-term success as a trader, period. So if you don't have them, you're just going to continue to live this up and down or have this up and down type of trading career, which is going to lead to a whole bunch of frustration and anger and a bunch of other things, and it's going to turn out to be a mess. So that's what we're going to focus on here in today's DVD. Again, I want to thank you for watching this. So without further ado, let's get started and enjoy. So I want to start out with helping you build the right kind of trading foundation. And to me, this sets the tone for everything that you're going to do going forward from here. So it doesn't matter what level of trading you're on, whether you're just getting started, which is very important to build the right foundation, or if you're a struggling trader and you're just bouncing around, having a hard time being consistent, you have a foundation problem. Everything goes back to the foundation that you have as a trader. In order for me to do that and help you look at the market a little bit different, I want to talk to you about the three components that go into every trade, because a lot of traders just feel that trading is just a matter of buying and then selling. And I guess in theory that's true, but to me it goes way beyond that, especially if you want to be successful. So over 2 decades of me doing this, I've narrowed down that every single trade that you make takes 3 quality components for it to work. And also, if the trade does not work, you can go back to one of those 3, maybe it's 1, maybe it's 2, maybe it's all 3 of those components, and you can find exactly where you went wrong as a trader and correct that component or that piece of the trade. And what those 3 things are is idea, execution, and management. So if we start out with your idea, this is what a trader would refer to as a strategy or a process. You're going to have something every day to come. You got to figure out something that you're going to trade. There's just too much stuff going on in the market. You've got big beta stocks, penny stocks, you've got foreign currencies, you've got futures, you've got option contracts, you've got binary options. You know the list. There's thousands of different things going on. There's thousands of different stocks being traded. In order for you to be successful, you have to eliminate just about everything and just focus on 1 to 2 solid pieces of trading strategies and trading processes in order to be successful. Otherwise, you're just going to go around and around and you're never going to be able to do the things that you need to do to be successful. So when we talk about the idea, we first must generate an idea to enter a trade. We come up with whether it was a guess, a tip from a neighbor, something we saw on television, something that we used in our own research, but we initially generate an idea and we say such and such stock is worth such and such. I think it's going to go higher. That's your generation of your idea, and that's thus what we call our strategy. Now, the next piece of that is once you come up with this idea and you think that something is going to happen based on whatever research it might be, the next part of that will be the execution, and that's what we call our entry price. So once you decide that, hey, I think Starbucks is a great stock because I drink tons of coffee, I want to buy it because I see it's going higher. The next step is, well, where am I going to buy it? Such as, is this a good price right here? If I buy it now, am I overpaying for this? Now, I know a lot of you this might be new to you as well. You might not know that. We're going to cover a little bit of that topic here in just a minute. But that's what we talk about the entry. So the next step is once you come up with the idea, you'll have to come up with the entry point and what is the best possible execution of this stock and what is the best execution price for me to get in. Again, we'll talk about that here in just a little bit, but that's what we mean by execution. Now, the next step to me is what really makes or breaks a trader, and this is this area is what's responsible for the success or the demise of most people, and that is the management of that trade, which ultimately equals the exit. It's common that a lot of people come into trading and they figure out an idea, they execute the idea, but then they've never really thought about, so when do I sell this? What's a good price for me to get rid of this? When should I get rid of it? How do I know if it's a bad, like if a stock starts going down on you? You often say, well, should I hold? Should I stay? I mean, I'm sure you guys have had these questions that you ask yourself. I have had these questions. I've asked myself in many years in the past. But to me, the management is going to be the biggest piece of this puzzle because it is what you do after you execute your idea that makes all of the difference in the world. Now, what we want to focus on going forward is taking this idea and building on it, because the most successful ideas come from identifying the right stocks to trade. This is something that's often overlooked. Like I just mentioned Starbucks as an example. Now, not every day of the year, Starbucks is a great trading vehicle. In fact, most of the time, for a day trader, it's probably not a good trading stock at all. That doesn't mean that it doesn't go higher, it doesn't go lower. It's just that what a day trader looks for, the amount of opportunities that the market produces on a daily basis, the news events and such, doesn't necessarily always bring up something like a Starbucks. And certain stocks will go through a cycle or a certain period of time where they're under accumulation, such as money will flow into tech companies, something like an Apple, maybe a Netflix or a Tesla. And then it'll move out of that and maybe it'll go into retailer names like a DEC or something else, a Lulu. It doesn't matter, but there's always a money cycle And there's always money moving in and out of stocks in different sectors. So one of the best ways to generate the right idea for you is to focus on identifying that right type of stock that's under an accumulation phase or that has the certain volume or the certain range that you're looking for. The next thing that comes with ideas is assessing the type of risk versus the reward that you're going to take. Now, this might be strange to some of you if you have no idea what trading is, you're just trying to learn. Again, we're going to talk a little bit about each one of these, so I don't want you to feel overwhelmed here in the beginning, because I will show you how you can find these, or at least get a good basis of finding these things. But this is what's important, and as if you're taking notes or you're rewatching this, again, the idea of building a successful idea is not just throwing darts at a piece of newspaper, at a stock ticker, or taking a tip from television. It's number one is identifying the right kind of instruments that you should be trading on a daily basis, and then assessing the best type of risk to reward opportunities. Now, when it comes to execution, what we want to focus on is when should you actually enter a trade? Like, again, when you come up with the idea, the next part of the execution is when do I do it? You know, there are certain times out of the day that are more advantageous for entry points. Maybe some of you don't know that. Again, these are things that we're going to talk a little bit about here in just a moment. Don't feel overwhelmed. But there are better times to enter trades. And then, of course, how much position size should you use in something like a trade? How much risk should you allocate to this idea that you have? I mean, is this a quality idea that's in front of you? Is this a 50-50 idea? Do you not even know what level of idea this is? So these are the questions that you have to ask yourself in each and every trade. And of course, the most important, as we just did discuss, will be that management part of the trade. Like, when do I actually get out of this? It always amazes me still. I guess I shouldn't be amazed, because I did this a lot when I started trading in '99 and stuff. Is I always had great ideas and always could get in the ideas with execution, but then I really didn't have an exit strategy. I didn't know, okay, now's the time for me to jump. Now's the time for me to bail. Now's the time for me to double down. All those good questions. And to me, this is really where the focus of each and every one of you needs to be in order to be successful, because we've all been in situations where we've sold winners too early and held on to losers too long, simply put. So when do you exit? You know, when do you know that you're wrong on your trades? You know, how do you stop fixating on certain stocks and opportunities to where it consumes you and you end up making a bad decision based on maybe the way your P&L looks, or because you're nervous about being in a trade? And should you do partial positions? All these good things. We're going to talk a little bit about each one of these here as we move forward. But the basis that I want you to take away from this is that those three components go into every single trade. So we can often have a really great idea that we come up with, and we can have a really good execution of that idea. But then we can chicken out and leave money on the table and just sell it. Or if it goes against us for a few minutes, we sell it, we panic. And we blew that idea. We ruined it because the management was really bad. Sometimes we have a really good idea and then we just screw it up right from the beginning because we overpay for that security, stock, or whatever it is. And we we lose money that way, and we screw it up by the execution. And before we move on, the last thing I do want to touch about why this is so important when you're looking at idea execution and management. And that's because if you come up with a losing trade, for example, and this is where I feel it's more valuable to the trader, it's often the easiest go-to excuse when you lose money is to say that was a bad idea. Now, in theory, of course, it's a bad idea. It's always a bad idea to lose money, right? Nobody wants to lose money. But when you look at, that's the first place that you go. You say, I lost money. What a dumb idea. What a dummy I am. But maybe it was a really good idea. Maybe the reason that you lost money on it is because you had a really poor entry price. You had really bad, you just screwed it up from the start. You said you were going to do it at one price and you did it at another, and you knew you overpaid for it. So it kind of puts you behind the eight ball to begin with. So maybe your execution was bad. Maybe it was your management, which I think most trades fall under that is, you sold it too soon. You got rid of it too early. You panicked. You made a mistake with that. So it's important for us to know that. So when you go back and you look at your losing trades, What you should say to yourself is, and this is where you know you've reached a certain level of professionalism in your trading and you're on the right track to being successful, is when you look at a trade and you say, it was great idea, it was great execution, it was great management, the trade just did not work. That's all there was to it. It was just a matter that it did not work. And if I saw this setup or I saw this situation occur 10 times, I would take this thing 10 times. That means that your losses are not based on your mental stability, your management, your idea, your execution, or overall your self-sabotage. That means your losers are just coming from your natural losses as a product of the nuances that comes with a market, because nobody's perfect. We all lose, and that's how you should look at it. You should go back to each and every trade and say, hey, that's it. I would take this over and over again. I did a good job with all three of these. The trade just didn't work, simply put. So we'll start moving on here, and we'll talk about a couple of these things, how you actually generate these ideas, how to find proper execution, and how you do quality management with each one of your trades. Okay, so how do we answer all of the questions I just proposed to you, such as how do you know that you are trading the very best ideas every day of the week? How do you know that you're getting the best execution price on all of your trades? And more importantly, how do you know that you are managing every trade to the best of your ability, that you're not sabotaging yourself, that you're not cutting your own throat, that you're doing the very best possible job that you can with managing each and every one of your trades? The way that we do that is through the use of technical analysis. Now, I do understand that many of you that are watching this have some sort of a trading background, and you probably understand to some extent what technical analysis is. So some of this might sound a little bit rudimentary to you, but just follow along here for a minute, because there's many things about technical analysis that aren't always answered in books and DVDs. Also, I do know the reason I'm going to spend a few moments covering this is because many of you don't know what it is, and you're watching this for the first time, and you need to understand what it is that we're looking for when we go through the idea, execution, and management. Now, the quick part is people say, well, what is technical analysis? And the definition for that you look up right on the internet is it's analysis that uses patterns and market data to identify trends and make predictions. Well, I don't like to use the word predictions. To me, technical analysis is more than that. It's about price discovery. It's about patterns, and it's about price discovery. Now, remember we talked about execution there, understanding if you're getting the right price. The way that you find the right price is by looking at the chart. Now, we're going to take a look at a few charts here in just a second so you get an idea of what we're talking about. But it's through the usage of understanding where buyers and sellers meet, for example. So the most important thing to understand about that is, number one, it's the usage of patterns, rhythmic pattern movement, such as a behavior a stock has over and over again, areas that it moves to, areas that it moves off of, the way the stock behaves. And this is something that a lot of traders never really look at. And why a lot of us like to trade the same stocks is because since people trade stocks, stocks have individual behaviors. They also have behaviors in the way that they act, and this helps you make money. And the other important thing here is price discovery, is finding the right prices. So why we use technical analysis rather than something from a fundamental standpoint, which is, let's go back to Starbucks for the lack of using, I don't know why I got on Starbucks, but maybe because I was thinking of having Starbucks, who knows. But let's say Starbucks, for example, a fundamental analysis that would look at this would say, you go into the store and you say, man, there's a lot of people in here and I love their coffee. I'm going to buy it. Now, that's a fundamental decision because you're buying that stock based on an emotional decision, such as what you're seeing with your eyes, such as there's a lot of people in the store and that you love this coffee. Therefore, it's a good stock. Now, you may take your fundamental analysis deeper than that by looking at the records of the company. What is their profits? What is their profit margins? How much did they make on a cup of coffee? What was their last quarter report? So you're using a lot of speculation there to try to make money. Where technical analysis is looking at something and saying, this is the price Somebody wants to pay for it. So remember in the last slide, I said price discovery. So regardless of what your thoughts or feelings, let's just continue to stay with Starbucks. I hope you guys didn't get a bunch of losses on Starbucks before, and I'm bringing up old wounds. But let's continue to use that here, is that regardless of what you think, whether it's a good company, it's a bad company, it's oversold, it's overbought, none of that makes any difference, because when you're using technical analysis, all known information about that stock is reflected in the price that it's trading. So if you look at something that has a huge cult following, a company like Tesla that does not make any money, that has losing quarters, then nobody can figure out how they continue to stay open. And the fact that it's trading at $200 to $300 a share at times, that's not important. What's important is it is trading at that price, and that is the price that people are willing to pay for it. So you can say the same thing about Bitcoin. Does it matter that Bitcoin went from 100 to 20,000, or that $20,000 was too much? Well, no, because if somebody's willing to pay 21,000 for it, then okay. And I think that's what goes that way with any sort of environment, with real estate and so on. The reason, to get back on point, the reason that we use technical analysis, it's the purest form of understanding what a stock's value is, because it's reflected in the price. The other thing is technical analysis allows you to identify where buyers and sellers are. Now, if you've ever looked at a chart, again, we're going to take a look at some, you're going to find that there are certain areas where a stock stops going down, and there's an area where a stock stops going up. There's stocks that trade within certain dollar amounts continually over and over again. And the reason for this is because it lets you know where are buyers and where are the sellers. And simple technical analysis can tell you that. It also helps you identify, like we said in the beginning, buy, sell, taking profit, or accepting loss. Technical analysis will help you come up with the answer for each one of those. And it also allows you to identify those most explosive opportunities in chart setups, where charts line up, where certain time frames of price match. So before we start looking at charts and we start to talk about charts, what you need to think about is that price discovery. The areas where buyers and sellers meet on these charts, because that's most likely where you're going to see explosive moves. And then once you make your decisions, the charts will tell you as to whether or not the conviction that you had in this trade is correct or you were wrong. And that's also something we'll discuss a little bit later. It's important to understand when you are wrong so you can get out of the trade as quickly as possible. Now, one thing I do want to go into before I talk about the charts, it's very, very important that you take two things away from technical analysis, which many of you may already know. This may be a hindrance point for some of you. Technical analysis is not perfect. By no means is this perfect. You know, there's no such thing when it comes to trading. Perfection in trading just does not go hand in hand. Technical analysis is just a roadmap. It's just something that helps you make a decision, something that helps you stop looking and take action. So it's just something that puts you into the trade and helps you say, okay, look, when I see this setup, this pattern, so to speak, I know that 80% of the time this is going to be the end result. Every time this thing hits $50, it sells. Every time this hits $50, people buy it. It's understanding that. It's just a roadmap. It's just something like when you have a map on the wall and people put little pins and dots on it where they've been throughout their life. It's just somewhere where you can just point to a chart and say, I'm a buyer here, I'm a seller here, I can make a decision. That's all it's for. That is all it's for. And don't overdo it, because this is what a lot of traders will do. They're looking for a holy grail type of system, because a lot of people are selling that. They're like, look, I got a great system. No, you don't. You do not have a great system. Maybe we have a system for you, but it's not something somebody else has not figured out. I mean, the market's been open for, I don't know how, like 100+ years or something like that, maybe. I don't know. A long time. Everything has already been done 1,000 times over. So what I'm doing is not a secret either. It's just The difference becomes, can a certain trader use it and make it work for themselves? Now, it's a little bit different topic. So what I say when I'm talking about overusing it is you don't need to draw a bunch of lines on there. You don't need a bunch of Fibonacci cycles. You don't need a bunch of MACD crossovers. I mean, if you find a way for that to work, fine, use it, because to each their own. But starting out, especially for those that are starting out or struggling, it helps to just go to the basics, which we're going to talk about, and understand the basics of fundamental buyers and sellers. That's all you need to know. And you just need to find an area on the chart where you can do business. That's it. That's all technical analysis is. It's not perfect. Now, the easiest way for us to do this technical analysis, and the simplest piece of technical analysis, and to me, if you just have one thing you've got to rely on, the essence of all stock trading, to me, revolves around the use of support and resistance, which is simply identifying, where do people want to buy this thing? Where do people want to sell this thing? And that answers a lot of questions for the trader. Now, I did a video a couple of years back. I couldn't be any more thorough about support and resistance. So I'm going to show you this because I think the charts are older, and forgive me for that, but I think when you just look at the fundamentals about support and resistance and the explanation of how it works, seeing where certain levels are, I don't think I could do a better job just sitting here telling you. I mean, it's a very popular video. A lot of people have watched it. It's posted on YouTube. So I'm going to show you that for a second because it's a great understanding about how technical analysis works. When that's done, I'm going to show you how it works with newer charts and some updated charts that you may be trading, so that you can understand that it doesn't matter whether the chart you're looking at is 5 years ago, 20 years ago, 10 minutes ago. Support and resistance works, and it identifies price. So we're going to take a look at that now. It's going to tell you what you need to know about the support and resistance, how it works, why it works, certain areas, certain levels. And then I'll show you that against some newer charts and how it works in today's environment to show you that it works then, it works now, it will work in the future. All right, let's get into a little chit chat now about support and resistance. And I want to just apologize up front. I might get extremely emotional and crazy, really excited talking about support and resistance. And this kind of goes back to many years ago when I was a struggling trader. I didn't have any process whatsoever. It was like dart throwing and just really guessing. I just did not have a process. And when somebody showed me support and resistance, first I felt like an idiot. I can't believe that something that is so easy. I mean, guys, this is going to be like one of the easiest things that you'll ever learn. And you probably already know quite a bit about it, but we're going to talk really deep about this subject. I just couldn't believe that something so simple worked so well and was so reliable. And I mean, isn't that really how life is? It's like the most simplest things are the most beautiful in life. And for me, support and resistance was one of the defining things in my trading career that just turned it around for me. I was just stunned. And still to this day, 15 years later, I can't believe it. I'm in shock. It's just like, wow, I just can't believe it. So you might hear a lot of excitement coming out of my voice. I apologize up front for that. So as I talked to you a little bit earlier, technical analysis allows us, really defines important inflection points for us. And stocks, they just don't normally change direction. I mean, occasionally, yeah, they will. Nothing is perfect, but normally a stock does not change a direction or pivot at a certain level and then trade right into another level just because it wants to. I mean, there is a very specific reason that a stock trades like that. That a stock moves from one price, like from support right into the next resistance, or right from resistance back down to the next support. I mean, there's a reason that stocks do that. And this is where it comes in handy for you. It's more than handy. I mean, this is what makes the difference for you as a trader. Is, let's use this as an example. How many times have you been in a trade and as soon as you get into it, it makes a pretty good move? I mean, you get a nice little pop. And the first thing you think of is should I sell it?
is, should I get rid of this stock? Let's say you buy a stock and it pops 30 or 40 cents and you're like, ooh, should I take this money? And then it jumps 30 cents and it just stops. And it just starts trading in this really tight 5 to 10 cent range, for example. And it does that for like 30 minutes. And as it's going back and forth between this level, you start to get really frustrated. You start to get impatient, and you got that little devil trader standing on your shoulder, like poking you in the neck, like, hey, sell the stock, sell the stock. It's going to be a loser. It's going to turn into a loser. And the longer it stays in that consolidation, it's bouncing back and forth, the more it starts working on your brain, and you start to second guess yourself. You're looking at that gain. It kind of looks pretty good. Maybe you've had a really, really tough day. The last couple of trades have been losers, and you got this kind of okay win. It's not great, but you got this okay win, and you're battling back and forth in your mind as to whether or not you should take this. And as I said, the longer it goes on, the more it works on your brain, and then finally you're like, you know what, I want to take it. And then you get rid of it, and 5 minutes later, the thing just shoots up another dollar or so, and you left a few $100 on the table, and it was like this big defining trade. I understand, man. I'm not calling anyone out because I've done this. I can't tell you how many countless times I have been in that situation, and every once in a while I still get into it. But what I want you to understand is, if you're one of those traders who has very little tiny bit, little small itsy bitsy gains, and then you have really huge losses, or as soon as the stock goes into the green for you, your impulse mentally is to just take that money. Like, I got to get the money, I got to get the money, right? You just can't settle down. Most of the reason that happens, or reason if you have that kind of a problem in your trading, and you're getting shaken out in these trades, or you get into a trade, even if it didn't pop, let's use this as an example. Even if it didn't bounce in your favor, just kind of slid a little bit into the red, and you were like teeter-tottering between red and green, green, or a little bit in the red. You know what I'm saying, right? And it's working on your brain. The reason that you get shaken out like this, or the reason that you have little tiny gains and huge losses, or the reason that you can't be patient with these positions, is because you haven't been able to identify the high probability area that the stock you're in is going to trade to. You are not looking at the most likely target, because a stock, let's say you're bullish, and for example, we're trading a stock that wants to go up. It's unlikely that the stock is just going to go, you're going to hit the button, right? You hit the button, boom, stock goes straight up in the air, and you're all good. $2 move, you cash out, winner. Yeah, you're going to get those, but when you think about your trading, I mean, how many of those do you get that you just hit the button, you're immediately in the green, and you're banking? You don't, right? You just don't. Most of the trades they're going to screw with you, right? They're going to bounce around. They're going to move in between these levels. They're going to shake all over the place. And right now, with all these algos in the market, you're going to get some wild moves, like a really big red candle and a big green candle. There's going to be all of these little tiny fake out zones. And this is what causes traders to lose not just focus and concentration, but this works on that psychology. We're going to get deeper into psychology later in this DVD, but that's what starts to wear on you. And you take out the money, and then a lot of times this costs you a very good trade. And in reality, what you have to do now is you now have to go find another good trade, right? Now you're increasing your chances of losing because you were just in a really A-plus quality trade, but you kind of wussed out. Again, I'm not calling anyone out. I've been there. That's how I know. I've been sitting in these shoes for many years before. I know how this works. So the reason that happens in most cases is because you're unable to identify that level. And with support and resistance, to me, and I'll show you, it will give you a lot of clues to help you prepare far in advance of how this works, of where these targets are, how to kind of recognize what a shakeout is, how to know whether or not the stock you're in gives you the opportunity for a much larger gain, and so on. Also, what it's important to use, because when I showed you all of the charts, I showed you 5-minute charts, 1-hour charts, daily charts. It's important to understand that support and resistance, as well as any indicator that we talk about, I should touch on this. The longer that you go back into time, the deeper that you go back into the time, the more important that support number, that resistance number, that level, more important that is. So let's say, for example, a certain stock is bouncing or holding a $50 price point. And it's been doing that for the last 3 hours. It's been going straight across, right around 50 for the last 3 hours. It's just sitting there. Not only this, when you're judging this particular level, well, let's just say like it's been holding that for 3 hours, and that's the only 3 hours it's been holding 50. Let's try to clear that up. So it's just been sitting there at 50 for the last 3 hours, and the stock was trading at 45 yesterday. Just kind of gaps up 50, and it holds 50. Now, certainly that 50 becomes an important area, and it's one that should be recognized. But in reality, it's only been holding that level for 3 hours. Now, maybe, like I said yesterday, the stock was trading at 45, and it held above $45 for the last 8 months. So if it held over 45 for the last 8 months, the 45 is a much more important support level than the 50. Now, of course, maybe while you're trading, like you're a day trader, maybe 45 is not going to come into play the day you're trading. So 50 really is all you have. So the 50, hopefully I didn't confuse you there, but the $50 is only a 3 hour or 4 hour support, or development of support, or establishment of support, or maybe the 45 went back 8 months. So the 45 is so much more important because it's established itself over a longer period of time. So again, if you're a day trader and you're making a trade, that 50 could be a good enough level for you to manage risk. But say if the stock was to lose 50, it was to sink below 50, it just could be a small fade that day. It just could be an algo or a stop trip bar or something like that. It just flushes out 10 or 15 cents and then bounces up. Now, let's say it would ultimately test 45 that day, which would be a pretty big move, but let's just say hypothetically it would test 45. If it were to ever lose 45, most likely, in most cases, the consequences would probably be far more drastic than it losing the short-term support level from 3 hours old. So I think I've kind of made it clear there. Always remember that if you're looking at longer-term data with support and resistance, it's going to be a lot more valuable. Going back to when I was showing you the charts, that's the reason for the multiple time frames. Like, I'm just going to throw this out here. It'll make a little bit more sense later to the newer traders. Is that if I'm trying to trade a breakout, for example, and we use $50, if that $50 is breaking out on my 5-minute chart, which was on top, and then I glance down and I see that that $50 is also a very important resistance level on the daily, those two time frames would match. And the fact that the daily chart, maybe this thing was using 50 as resistance for the last month. Now I know if it breaks 50, not only would it be a good trade normally standalone on that 5-minute chart, but it's probably going to be a lot bigger move because now we'll be clearing resistance that's really been a hurdle for this stock that might go back 1 month, 2 months, 3 months. And again, the further you go back, the more important this is. If it's a year, this could be one huge move. And you as the trader, what you will learn, just going to kind of touch on it real quickly here before we move on, what you'll learn is this will help you develop where your risk should be, how much position size you should allocate, and the quality of the trade that you're in, because you'll learn not all breakouts are created equal, not all time frames are created equal, not all support and resistance lines are created equal. There is a difference in what you are seeing, and us as traders being able to recognize the level of opportunity allows us to gauge the level of risk, and ultimately does the number one thing for us, makes us some bank. So let's take a look at this, how this works in real time on a chart. Take a look at a couple of charts so you just get a good feel of how support and resistance works. Okay, now we'll take a look at just simple support and resistance. And what I want you to remember as we're going through this, that it doesn't have to be 100% perfect. Remember at the very beginning of the technical analysis, I said it's just a reference point. It just puts a spot on the chart, like putting a thumbtack like they used to do in the old days on the map. Just pinpointing an area where you can make a decision. We don't have to get to the exact penny We can't be that perfect or expect that much out of ourselves. It just gives us an idea of where a stock might trade to. It helps us manage the risk. It will let us know. Sometimes it'll even help us keep us out of a trade. If you really want to buy or you really want to short a stock, support and resistance will give you an idea of whether you should go for it now or whether you should wait. And we just want to keep it simple, no other indicators on the chart. And the easiest way to do this is start from the nearest support and resistance levels and then work your way back. So as a day trader, let's say I want to trade this EGRX. We're going to look at a couple of the levels here. And just while you're new at this, if you're kind of struggling with it, or you've been in a while, you just want to reconfirm how good this works, just draw you some lines on the charts. Once you learn how to draw them, we'll show it here. Just draw them out. Pick you 3 or 4 a day, then go back at the end of the day and see how these stocks react at those levels. And that's what we're really in it for. We want to see how they react at those levels. So we'll start with just the highs of the previous day, and then we'll trade it into this day, or we'll do some thinking trades here. So we got the high of the day, which is roughly around this, let's say 73 area. And just draw these out as far as you can, but I'm just going to go as far as I can here. Again, they don't have to be perfect. And you got a little bit of short-term support right here. And as we discussed, this is very, very short-term. This is a very, very short-term number, at least now it is. And this is a very, very short-term support, right? Because you're only going back maybe 2 hours here of a range. Now we want to go a little deeper, so we'll go back down into this pivot that was a little longer back in time, but still that previous day. And then you'll get down into some of these levels here, which was around the opening price of that day. And then maybe kind of walk back over here and look for this, which is a couple of days prior, 2 days prior. This is actually a 2-day viewpoint of the chart. And now you got somewhat of a range to work with. I know it kind of looks messy, and as you progress through this, you won't need to draw these lines. You'll just be able to see this with your eye, as you will a lot of these indicators. You won't actually need to draw them out. You'll know, you'll be able to see it, but just for reference. So you've got a few areas here of numbers. So rather than just saying you're a buyer or you're a shorter of this EGRX, you have levels that you are interested in doing business. So for example, if we were to break out above 73.34, then I would view this as a potential breakout chart. Now the question for a trader would be this: if you were going to buy this stock, the first thing you would have to do is assess how much money would I be willing to risk in a trade, right? I mean, that's what all of you want to know. It's like, well, how much am I losing? How much am I going to lose if this trade does not work out? That should always be your first thing, is what is my risk? So if you are to buy this, let's say 73 to make the math easier. If you are to buy this at 73, your risk would have to be all the way down here at 71 at this last support, because it could easily just flush back into the support and then bounce again, right? How many trades have you been on? Like, it popped, you bought it, it sunk, and then you lost money, and you looked at the money, you said, hey, that's too much money for me to lose, and you sold it, and then it just bounces off that level and goes higher. You'll see that, and I'm sure you've been in those trades. I have too. So the first thing you can kind of think of, just common sense will tell you, well, if that's going to be your risk, we've already determined you got about $2 worth of risk just to take this trade. So if you just drop 100 shares on this and you're wrong, bye-bye $200, right? So that's pretty wide. But is it worth it? The next thing would be to look at the next resistance level. Like, if it was to clear that 72, 73 level here, if it was to clear this, where would this thing go? Well, your next area is this right here. And try to draw for you right here, right? This little high, roughly, I'm making a mess out of the chart, but roughly around the mid 74s. Okay, so you're looking at about a $2 move. You know, if it's going to break out, there's a good chance, maybe not all in one move as quickly as we would like it, but the chances are that it will trade into the next resistance. It's not a guarantee, but there's a good chance that it might get back up here to this high. All right. The thing you now have to assess is your risk to reward. Now we'll talk a little bit about this later as well, but you're risking $2 for a possible $2 gain. To me, as a trader, real quickly, I can tell you that's not very acceptable, right? You're 1 for 1. A good trader should be minimum 2 to 1 or 3 to 1. Now, you're not always going to get that. You're going to spend a lot of time just taking scratch trades and trades that go nowhere, but you should always at least try to focus on that, because that puts the risk to reward in your favor. Because if you're taking too much risk, then your losses are far outweighing in any of your gains. But again, that's a deeper topic we're going to talk about. But at least here as a trader, you've got a couple of levels. It's a possible bullish chart at 72.98 or 73, and you could break above 74. Now, if it gets to 74, you'd have to look at the next level. If it blows through 74, then maybe it's 76 or 77. You can easily find that out in the chart. Now, we know that down here is the support. So on the flip side of that, if this stock is to lose this little bottom area, let's say at 71, to make the math easier, the next area of support is all the way down here at 68. Right? So there's a good chance that if it breaks that level, that this has a high probability, or at least should be considered, the next level of support, right? So right now you could probably think how easy this is to use and help you clear up your decision. So like, let's say you're a trader, you're just going into the market, you have no idea. At least this way you have an idea. You've got some numbers. Possible breakout here at 73. It's not really a great risk to reward trade, but maybe it'll set up a little bit better intraday. We know that level. Possible short trade. Possible short trade on breaking this 71, because this 71 is a short-term level. Now, certainly the short trade would be more appealing, because if it breaks out, then you go from possibly 73s, right, into the 72, 73, you get $2. But the downswing could be about $3 to $4. So there's a lot more room on this to the downside if it breaks this level for profits. So a little bit more risk to reward, but we'll take a look and see how the chart works. Now, as it goes deeper, if it gets down into the 66.53, these are much deeper, right? We're going back further in time. So you go here, the 66 is much more important than 68. 68 is much more important than 71, because they're further back in time. And you can always take a snapshot. I like to do it right down here at the bottom, highlighting that area again. If you look just right at the top of a couple of these last few days, you're right there in that 73, mid 73 level, which is just right about here where this breakout is. This is a pretty important level if it's able to clear it. Again, what you do want to know as a trader, the important part is, if you are in this stock and it gets there, you at least know, no matter whether you're short or long, you guessed on your entry, none of that makes, it does make a difference, but none of that makes a difference in this example. What's important is that you at least know where the stock may stall in price. Because if it does break out, it's probably not going to just blow right through that. Sometimes they do, but it'll probably just stop and trade sideways around there for a little while, catch its breath, so to speak, and then maybe gear up for the next move, right? So at least you'll know ahead of time where trouble lies ahead. And to me, that's one of the big benefits of the support and resistance, is when I'm in a trade that's kind of putting you in that up iffy spot, like where are we going to go? Where are we going to bounce? I look for those future areas. So if I'm short, I'll realize, hey, if I get above that area, I could get squeezed. It needs to stay under this area. Or if I'm long, it needs to hold this area, and so on. So we'll let this thing play out here throughout the day. Then we'll take a look and see. Okay, so here's what I want to do just real quick. I want to pause the chart, and I want to open this up. You see how the first, this is the 5-minute bar. You see how the first bar just shot up right from the open from 72.29 into 72.84, just for reference. Okay, you can see it right there, just right at the top of that. It didn't last very long, and we'll talk about that in a second. But The important thing here that you know is it bounces real quick. So at one point here, this was all green, and it looked like a breakout, right? There for a second, it looked like a breakout, and certainly there's orders on here. So people bought this stock right up here towards 72.80. When you think about this as a trader, and sometimes you have to say this out loud to yourself so you know how crazy this can be. Why would you buy a stock that bounced already? You know, if it opens up here, it's at 72, shoots to 73, it opens up $1 within a few minutes. Why would you buy this here when resistance, good resistance, is just 20 to 30 cents away? You follow what I'm saying? Because now your risk is all the way at least down in the mid 71s. I mean, you'd at least have to give this chart down into the mid 71s. Why would you buy that when resistance is so close? Again, it might work out for you, but if this kind of works out for you, you're just, in my opinion, you're instilling very bad behaviors, right? Because what this is doing is it's getting you into bad habits. It's going to come back and bite you, because it's not about how one trade works for you with the strategy. It's how 10 trades work, because nothing's perfect, as I said. But see how important that is? Why would you be willing to take that chance so early in the morning, so close into resistance, after it's already made the move? The money would be on the short. Now, you need a little bit more data to confirm that short, but you see what I'm saying? Because you're so close, it would be easier to short the stock using that resistance as a stop, because, not whether it works or not, it's because risk to reward favors you. Because at that point, you'd only have to risk 20 cents for a possible $2 to $3 washout move. So we'll kind of take a look here, see how this plays out in a few more candles. All right, now you have a little bit of red into the candle. So now it's confirming to the downside. But for this to really move down, what's this next level? I mean, there's a good chance it's probably going to try to bounce, or you know, you're so close to the 71 here, this recent support, that there's a chance that it may bounce. So the question is, do you short it? You would want this to break down through the low of 71. If you do it now, again, same way as people did up here, buying it into the green, if you short it into the red, it might work out for you, you know, but you need a little more confirmation. You need that official breakdown to tell you. Otherwise, this just could turn into support and then break back out. So let's give it a few minutes here, see what happens, see how it handles this level. Now, you as the trader using the support and resistance, this is a very short-term level. So it's important now that it's at that level to see the reaction. Is the stock being bought up? So far, the answer is no. Is it bouncing off of that level? So far, the answer is no. Now, the longer it stays here and the inability to bounce will lead you to think, well, people aren't interested. Traders aren't interested in buying the stock right now. It's at a pretty decent, I say decent, it's not a great support level, but it's at a pretty decent support level. That's probably why it stopped going down for a second. So it's important for us now to take a look. As you can see this thing losing, you're having a struggle, the balance would shift to a short position. There's a good chance, because the lack of bounce, because the lack of interest that's at this support level, just the sheer lack of buying volume that's coming into this, it most likely will lose this level. And if it does, you as the trader, let's say first you're long this stock and you're being pushed. Where if we lose this level, do you think we're going to go? There's a good chance you're going to go down in here to the 68. That's a pretty far drop. So let's say you're long, it might be wise for you to stop out and take the loss. Because if it gets much lower, or it's unable to bounce here with any effectiveness, then there's a good chance you're going to go right back down into this 68. All right? And that's might be just too much of a loss for you. If you're short, and you only up a few bucks, you want to wait to see if this thing cleans out this level, which it looks like it's doing. And you want to be patient because the chances are you're going to get pretty close. Again, not 100%, but the chances are you're going to get pretty close into this level. The key here is this. You can see how support and resistance, and I hope you're kind of understanding how the support and resistance is working, right? One is it defines levels beforehand. And that's what we do as traders is we have a lot of anxiety sometimes, right? We have a lot of anxiety because we're unsure of the decisions we're making. This allows you to put some numbers on the board that says, okay, here is that area, right? And it gives you that. Then when it gets to these areas, it gives you the second reference of judging that area. Well, how's it hanging out? How's it working? How's the stock behaving at this level? And the more you trade, you'll start to understand how important that level becomes. Again, this level that we're talking about here, it's a good support, but it's not as big as this. It's not as important as this. So judging there, as you're seeing it happen and play out in real time, you can kind of see, hey, you know what? There's not a lot of interest here. People are losing. So you as the long might want to pull the stock out. You as a short, you may want to hold. Now, as we're looking at this, and I've been talking, you've probably noticed it just flushed right down into there, into that 68.88, pretty close to your 68.54, and it bounced. I mean, you got a pretty good bounce. It grows from 68.84 to 69.89. You got a whole entire dollar, right? Would you agree that's a tradable bounce? You could have actually traded that bounce. But here, let's look at it this way. If that was your motive to trade the bounce, then you would want to be using this as well, because as it flushed deep into this level and you saw all of this selling to begin the day, you realized, hey, I'm close to a very important level. I should maybe look for an opportunity to buy. As a short, you could say I probably would want to cover down into that important level. Again, because it's an important level, the chances are of a bounce or a pivot there is very high. You're probably going to see a lot more action down here than you did up here because of the time. So you can see you're getting a little bit of a bounce. And for some of those that are the scalper, the quick day trader, there's been, while I've been talking here for 15, 20 minutes, there's been a lot of trades, right? You could have traded just that little bar right there, just that little 50 cent, 60 cent bounce. And see, you get a really nice bounce. But what I want you to take away here from this is, it should not be a surprise to you, the trader. It shouldn't be a surprise. And that's what you're trying to do, is eliminate surprises. You had these levels laid out. The fact that it's bouncing here is not a surprise. So depending on your stance on this, it will help you make a decision. It will help you cut losses on a trade. It will help you maximize profits. So you can see how it works throughout this level. So I'm just kind of skip out of this, and we're going to take a look back at this chart at the end of the day and see how it worked around some of these numbers. Okay, now we're back looking at the whole entire day that has been played out. I'm just going to extend the lines that I was talking about. You can just kind of look that, last time we left off, you had this green bar right here. I'm just going to open this up just a little bit so we can take just a closer look. And it just kind of consolidated. You had a lot of bottom pivots. This 68.23 ended up becoming pretty good short-term support. And then the stock makes a nice little bounce. Now, it was never able to get back up to the opening high or this 73. So, as the day played out, hindsight being 2020, the stock was never really able to clear that level, at least for this day. Maybe tomorrow, maybe next week, maybe never, who knows. But it never really broke that level, so a really big up move was never in the cards. But you can see that when it got down into this level right here that we had talked about before the chart even started, before the day started, you could accurately get within 20 to 30 cents of a predictable bounce. So you can see that this level meant something. It didn't quite hit it to the penny. Again, it doesn't have to be perfect, but it got into that level from back here. It was able to sustain that level, and there was a bounce. As I said, you got a quick bounce here. It pulled back into that level for a little bit later and held for a while, held for a good 30 or 40 minutes, and then broke out of that short-term level and gave a nice little pop, eventually selling that off. And, the rest of the day, it just kind of based, right? It never really got underneath of that 68 level. So the two important levels, we'll kind of break it down this way. The two important levels where the big moves were going to come from the longer term support and resistance. They never broke. And some days you're going to have that. Some days we call this range bound. This move in between here is the range of the stock, how much its range is. And once you start putting that in together with the rest of these, you'll see how this is important. But we're going to stick on topic with just support and resistance. But it shows you here how this works. And it never broke those upper areas. It really gave you that big move. But there were a lot of nice moves. There were a lot of 50-cent moves, 60-cent moves. And for you scalpers out there, short-term traders, there's a lot of money to be made on a stock like this. And because, though, when you sometimes think about it, taking 50 cents, taking 60 cents, it doesn't sound like a lot, but it does add up. The thing, though, is when your profit margins are that small, 50, 60 cents, or you're trading a stock for 50 to 60 cents, it becomes even more important for you to be very, very accurate where your entry prices are. Because if you would have shorted this stock here, being short was not a bad idea. But being short here was a terrible idea, because if you were short here, you were shorting too close to a major resistance area. Now, perhaps it would have broke that. I get it. But if you keep doing that over 10 or 15 trades, that's a bad recipe. You're going to get smoked a lot. You don't want to be down in the hole. You don't short in the hole. You don't buy after a bunch of candles. Again, it might work, and times you're going to get away with it. But you don't want to be victorious about luck. You want to trade well. You want to trade clean, because over time, that's what makes you money. Getting lucky doesn't make you any money. Getting lucky puts bad habits in you, very bad habits that you may never be able to break. So you can see how important these things pivot at the level. Was never able to break. So the big move didn't happen, but there was nice little moves. So hopefully this helped you out with a little bit of support and resistance. And remember, as we move on to charts and live trades, you'll get to see how this incorporates with the rest of the strategies and just gives you that little bit of extra confidence. As if you're not sold enough, I want to show you one last example of how important this is and how much money it could save you. I understand that the recent events in the market is unique. We haven't really seen this in a while, big flushes like this, but this is when our analysis means the most. If you take August 24th, Monday, in the market, big panic over China, stock market just dumps, right? And you can tell from the action here in the morning that people aren't looking at technical analysis, right? They're afraid. And that's what we're talking about, judging emotion. They're afraid. They're just hitting buttons, selling stuff, and they're not paying attention. Because yes, although it looks very, very bad, the market gaps down from 197 to 186. It's down 1,000 points. Everyone's freaking out. People are tuning into financial TV shows for advice, when all of the answers that you need are right here. I want to show you. We're looking at the daily chart. I want you to go all the way back to this big vital resistance area right here at 180. Support area, excuse me. All the way back here. Look at this. Right? The last time this thing really, you're going all the way back almost a year. So this is a very, very important number. Knowing what you know about support and resistance, how probable would a bounce be there? Why would you close a position when you were so close to major bounce area, right? And as we play this out a little bit, I'll speed it up and a couple of times faster, but you can see the difference. People are panicking. They see this red, they don't know what to do, and then the market just rolls over and flushes. And people are selling positions, but they're doing so against such vital, vital areas. So if you're in a position, you're so close to support, it's worth holding. If you're a trader looking for a trade, you're talking about an incredible opportunity. So again, what you're seeing here, and look, it just comes right down into that 182, right? Very, very close. Again, it doesn't have to be perfect, but it gets down into that 182, and instantly, within a minute, this thing is already back $2 at 184. This shows you just how strong, where so many people, some people lost millions of dollars on this move that could easily been avoided by support and resistance. I think you get the point. Let's move on.
Okay, what I want to do now is just show you this in a newer chart. I know that video was very comprehensive. It went through everything from A to Z when it comes to support and resistance. If you've had enough of talking about support and resistance, just move on to the next chapter of this. But just for those that want to see how it works 3 years ago, 5 years ago, and today, and it will continue to always work, I'm going to show you this on some newer charts. So what I have here is Tesla. I've got two charts on this. I've got a 5-minute chart and a daily chart down below. Now, chart time frames are specific to the trader. This is just what works for me. What works for you might be something different, but this is a great benchmark for me to start because I like to look at those prices on two different time levels. Now, if you don't understand the Thinkorswim charting platform, the black area is the actual day's worth of trading. The gray area is post-market. So what you're looking at is 2 days worth of data on this intraday 5-minute chart. And this would be the open. So the first thing that we do is we start going from the nearest support and resistance and working our way back to gain some knowledge about price discovery, right? So we see that the high from the previous day here was $356. Again, doesn't have to be perfect, around $356. You see that Tesla tapped up here, hit that level, pulls back, found a base right here into this level. You can see multiple bottoms, then works its way back and stalls at the end of the day at this $356 level. Again, I can't stress this enough that many traders out there trading this would say, why can't it break this 356? Why does it keep selling at 356? Well, that's the resistance. That's what happens to stocks when they hit resistance. They most likely sell. So what happens here is the next day that the stock, it gaps up, and it moves above that 356 to 358 in the pre-market. This is the gray area. And then sells back down to where else? Who guessed it? 356. I think you can see it's just plain as day. So this 356 obviously becomes a very big level for you and your trading. And basically it is, if you stay above 356, this is bullish. If you're under 356, that is bearish. That's pretty much the short-term line in the sand. Now, when we do look at this again, like the video said, the longer you go back into time, the more important what it is that you're looking at. So if we go down in the daily, we look at something we have very, very different. And that is, you have a multi-time frame breakout. If you go back and you look a few days before this area, you've got resistance right at that level. So not only are you lining up on an intraday shorter time frame of $5 holding this 356, but that 356 is also important on a multi-time frame basis going back several days. So now the thing is, how important is that level? That tells you that this is not just an ordinary level. This is a very, very big level. So this, I'm going to fast forward the tape here. That way you guys can just kind of see. We'll walk you through each one of these steps here and see how Tesla works. And here's what I wanted to draw your attention to here real quick. Let's just go back one. And let me open this up, okay? Just so you get a chance to see it. All right. So what happens here is, obviously, first thing in the morning, what it does is it holds its gain. It holds that 356 and it takes off and it breaks the pre-market high of the 358.70. So it holds that and it pops up there, okay? Now, the thing is, we said as long as it holds up here, there was obviously money that you could have made for a trade going up here on this, but what I want you to look at is if it holds above 356, it's a long. That's really all there is to it. And I mean, certainly there's other things you can do to zero in a little bit better, but to make this easy, 356, above 356, it's a long, you know? And then the next part becomes, where do you sell this? Because it's obviously held itself at 356. So we know we've got a floor in to control our risk. So if we were to buy this stock right here at 358.9, let's say 359, we know we've got a floor in at 357 to 356. So we know what our risk is prior to taking the trade. The next thing that we want to look at is, so where would this thing go? What's the potential? How do we find that? We go to previous supports and resistance. So in this case, we're looking for previous resistance. You go back into this chart much further. Now we're going back a few months past, again, a very, very important level, and you're looking at some topping action around this 367. I'll draw this all the way out, just real simple lines. That's all you need to do. So you're looking at, hey, this thing has the possibility, it's not a guarantee, but this thing, like we said, should trade from one level to the next. So we should get up somewhere into this range, and that's the trade that we're looking for. So you got your risk in here. You've measured your risk to reward. You've got a good idea. You got a relatively good execution price, and you've got yourself, your management, wanting to hold it up here. Now I'll fast forward this again just to kind of, for the sake of time, moving through it. Okay. Now, here's the other thing to notice is that once this thing breaks through the highs right here, look at the size of this candle, okay? This is a $3 candle just shooting straight up. So when we kind of go back to the original part and we talk about idea and the execution of that idea, yes, the stock is pulling back here right now at this moment. But for that piece in time, when it broke through there, you saw this explosive candle. And the reason that you saw that explosive candle is because it happened at two different time frames. It happened at the intraday 5-minute time frame, plus it went through the daily highs through the chart. So when you see those combinations together, that's what normally leads to those exaggerated candles and those huge moves. So we'll fast forward this through the rest of the day here. You can see it's still grinding up. And we'll get a bigger snapshot of the whole picture for Tesla throughout that whole day, how it worked, where it traded, the different levels, so you guys can understand how stocks work, how things work, what levels that you're looking at, and so on. Okay. Just give me a second. I'm going to fast forward here all the way through. Okay. So I just typed in up here the time and pressed it forward. So here's what we want to look at now. Just this is what we're going to look at just so you guys continue to understand how valuable this is. So when this thing broke out, yes, it was dirty. And when I mean dirty, it's erratic in its nature. It's whipping people back and forth. And this is where the management comes in, because the management part of you, or what you're seeing in real time, is, oh, this thing's pulling back. Oh, it was up $3. Now I'm down $2. Now I'm up $1. Now I'm down 50 cents. And it's going back and forth. But you're failing to look at the big picture, because the big picture is, in all likelihood, it trades back up to the highs from a few months ago, which was 371, 370, 371. So when we look at it, where does it go? It gets very close to that level. Again, not perfect, but look where this thing traded all the way up to that 360, high 360s area. Traded right into that level. When it gets rejected, yes, there's a lot of traders going, how come it sold off here? Well, the reason that it sold off is because it's right up there towards resistance. That's the wrong time to initiate a buy. In most cases, you're too close to major resistance, you don't buy. Then the stock starts selling off. Where does it sell off? No surprise, it comes all the way back down to where else? $357, this high 356, 357, all over again, right? So you're the trader, you're sitting there, you have multiple opportunities. You could buy this, run it up into resistance, When it gets into resistance, you can short this thing, collect the money all the way down. Again, it's not a surprise as to why it's trading here. Now, as the rest of the day goes on, yes, the stock sells off, there's no question, but it still plays around all day with what? 356 bucks, this area, 356.50 is this spot we drew right from the pre-market, right here early. It played around with that the entire day. And of course, once it finally broke that, you saw some additional selling in that chart. Now that works for both ways. If you're to flip this chart upside down and you're looking for stocks that go through low a day, that break support down, they become shortable opportunities. You'll see more aggressive moves in that. But again, basically just looking at these numbers, I think the first video proved a lot of this, but looking at a newer chart, it does not matter. The theory here is stocks trade from one level to the next, and there's no secret as to why it held 356 at the open, traded very close up to its resistance from several months back up in between these two areas, and then once it fatigued into that spot, then it trades right back down into the support again. So your job as the trader is to identify that you're not buying here and selling here. You are buying here, selling here, and then rebuying it back here over and over again. Technical analysis, support and resistance gets you on the right side of the trade. It allows you to capture the max amount of money that you can capture, because you would know this stock has a good chance of making it up to that resistance point, and that's what you're holding out for. And it keeps you from panicking, because you know once it starts selling where it's going to go. So that's what it looks like on a new chart. Doesn't matter. It works. No matter what year, what chart, what day, what week, support and resistance works. All right, now what I want to do as we get towards the end here is I want to spend a little bit of time talking about you and dealing with you. As you know, I've spoken many times throughout these slides about how valuable it is to have the right type of trader mindset, because if you don't have the right foundation, you don't have the right mindset, the greatest strategy in the world is not going to work for you, because you won't have the self-belief and the self-confidence to execute that. The other thing that we have to understand is we need a series of rules. Every one of us traders, we need a series of rules, and the rules is to protect us from ourselves. It's to keep ourselves from unwinding. So when you think about it, we're just traders sitting here most of the time, all the time pretty much, alone, at home. Maybe you have access to a trade room. Maybe you just browse around social media. But for the most part, a trader spends a lot of time alone. And without guidance that's right there next to you, it's so easy for you to go rogue and start unraveling and make a bad situation a total nightmare. So I know maybe some of you have a set of rules that you have in place. I want to give you a few things that I've learned. I mean, everybody's rules are going to be different here and there, but I think there's a few things I can share with you that I've learned over 2 decades that I think is really important that any trader can use and that every trader should probably be using, because it's a great mental foundation about how you should conduct yourself as a trader. And one of those things is to understand that you are going to be wrong, and you're going to be wrong a lot. And it's really difficult right now to accept this sometimes, because like when I started, you didn't really have a benchmark of anyone to look at. You sort of learned trading on your own. Now with social media, all you really see is people talking about good trades, and it gives you the appearance or the feeling that everyone is doing a really good job and everyone's making a lot of money except for you. They seem to win every day except for you. We have to understand that on social media, people are only, most cases, going to talk about winning trades. They're not going to discuss their losers. They're not going to brag about losing. I mean, who wants to brag about losing? So you're not really going to see that side of people. You're only seeing the really good side of trades, or only hearing about the good part of it. So I want you to understand that, because one of the misconceptions that we have is you think in order for you to make a lot of money, you need to be right a lot. Well, you do need to be right, but it's more about making money on your winners and controlling your losers. You will have losers, and if you're going to do this over a long period of time, you're going to lose an awful lot. So it's something that you're going to have to get used to. As you progress, the amount of winners that you have and the size of those winners will increase, while the losers, you'll be wrong less often, and your losers will be far smaller, giving you the confidence to continue to trade. You also should rank every single one of your trades. Now, there's a video floating around somewhere. I think it's called "If You Don't Rank, You Won't Bank" on YouTube. It's on my channel. It talks about a little bit more in depth about ranking trades. And this is something that traders don't do, because when you're assessing an opportunity, they never really rank, like, is this a tier 1 opportunity? Is this a level 2 opportunity or a tier 2 opportunity? Is this a tier 3 opportunity? So you need to take each one of your strategy and each one of your setups and judge it on the highest win percentage, and the most success becomes a tier 1 trade. Now, why that's important is because as you're developing, you want to be putting most of your risk on a tier 1 quality setup play while reducing risk on junky plays. Now, one of the things that really hinders traders is something that's called revenge trading, which I'm sure most of you know what that is. You lose on a trade, and then you immediately want your money back, so you jump into another trade, and more often than not, that trade's a loser. Now, where that comes from is because you either blew an opportunity earlier, or you mismanaged a tier 1 trade, or you just got offended because you lost. And then what you do is you go right back into the market, but there really isn't a setup, and you can't be patient. You really don't have that patience. You want that money back now. So your instinct is to jump back into the market, which generally is maybe a tier 2 or a tier 3 play at best. And you put double the risk or the same risk on top of that. And then traders want to know why they go wrong. I mean, that's a recipe for disaster. So you want to have the most amount of risk on the best available trades based on your strategy, and ones that are not so, let's say, you don't even have to take tier 2 and 3 trades if you don't want to. But if you feel things are maybe a little less likely to work out, or you don't think you're at the right spot, then use a smaller share size by ranking your trades. You also need to set some daily stop losses and profits on you. Now, when we talk about losses, you've got to put something in place to where you have a max daily loss. Now, this is usually based on what is your max win. So if I were to look at 5 of my winners, I usually base it on 5 of my winners. What is the average of 5 of my winning trades? What is that number? So if I take 5 winners divided by 5, what is that number? And that number is my max loss that I can take on a single trade, and pretty much the single day. So the reason that we have this is because, let's say you start with 2 to 3 losses, or you have 3 losses during the day. You're 0 for 3, and you've reached a pretty steep amount of money that you're upside down on. It's almost impossible for you to recover that. In fact, you shouldn't really think about recovering it, because for whatever reasons at that moment, either your idea execution management is messed up, maybe the day is just messed up. It's not like the market doesn't have messed up moments and throws curveballs at you, But whatever the reason is, you are not on your game. You just do not have an edge in the market. So if you don't have an edge, then the best thing for you to do is not to trade for the rest of that day. So if you're cold and you're just not getting anywhere and you're losing money, just stop, because chances are you're not going to recover that money that day. You're only going to lose more. And trust me, the market will be open the following day, the following week, the following month, the following decades, and for the rest of your life, the market will always be there. Other opportunities will appear. Save it. Save your strength, your mental strength, and your emotions and your money for better opportunities. It happens to all of us. We go through cold streaks. We get beat up a little bit. The best thing to do is sit down for a moment, come back the next day, and just go. Same thing works with profits. Once you reach a really steep amount of profits for the day, it does help to reward yourself by taking the time off. Now, a lot of traders will say, but if I'm hot, I should be hitting it. I should be still rolling. I should be getting more aggressive. No, that's what you don't want to do, because most likely what you're going to do is change the makeup of your mentality. And what I mean by that is you will feel that you have house money. And when you're trading on house money, you'll feel like it's okay for you to lose this money. Therefore, what are you doing? You're taking tier 2 and 3 plays, maybe tier 5 plays for that matter. And you're just gambling. You're not really trading with an edge. So reward yourself. If you come right out of the gate, you hit a really nice profit, take the rest of the day off, reward yourself, and trade the next day. So it's important for every one of you to have daily stop loss goals in effect and daily profit goals in effect, where you'll quit trading. You will quit trading. Now, when I say daily stop losses for profits, I don't mean like set a goal every day and try to reach that goal. That's not something you should be doing in the market. You should just be trying to make good trades. But set these daily limits, because I've found out more often than not that if you push past those levels, you're going to be digging a bigger hole for yourself, and that's just something that you can't really afford to do if you want to be a professional. The other thing is, I highly suggest every single one of you is never, under any circumstances, look at your profit and loss statement throughout the day. I mean, just think about the stress that's causing you by looking at it. This is what causes, earlier in the management section where I talked about fixating on something. You know, the reason that you fixate on something is because you're looking at your P&L, because you're micromanaging every millisecond on that trade. But the bigger issue here is, if it hasn't happened to you already, it will if you're looking at P&L, is at some point you will allow the profit and loss that you're looking at to sway you from the chart that you're looking at, and from that idea, the execution and management. You will allow it to distort your perception about what is actually happening. So if we take that, let's say you're looking at your P&L and it's green, and maybe that's the first green trade you've had for a while, and you're seeing that it's green, and you feel, look, I really need this win for emotional reasons. I really need it. And you take that money, and you took that money, but maybe that was the really good trade. You took it way before the next resistance, the next trading level. You basically sabotaged yourself because you let your P&L influence you based on the amount of money that was on there. It works worse in reverse when you're looking at a negative and you see, oh my God, I'm really down a lot of money. You see that big red number, and it's always twice the size in red as it is in green, right? It always looks so much bigger in red. It's like somebody's yelling at you or something, because it's in caps. But you look at that and then you say, I can't stand to take another loss. And you know, I can't deal with this loss. I can't deal with this. And then you cut it, and then later on the trade would have worked. And the reason is because you allowed your P&L to influence your decision, when what you really should be focusing on is the chart, the support, and the resistance. And the other thing, I've always said this for so many years, is that the basis of all trading is not about making money. It's about making good trades. And I don't know if there's a truer statement when it comes to talking about traders and trader performance. If you get up every day, this is why I say it's tough to use goals, because the market, you're kind of a prisoner to the market. The market has to do what it wants to do, because you can't control that. And then you act accordingly. Now, some of those days are going to be fantastic. And other those days, you're just not going to be able to get anything going. That's just the way it works. So rather than focusing on money and saying, look, I have to make money, I need to make money, I want to make money, Your focus should be on, I have to make a good trade. I need to do the best with this trade that's in front of me. I need to manage this trade well. I need to find the right idea. I need to execute to the best of my ability in my game plan. If you focus on that part and you don't look at your P&L and you don't worry about those other things, trust me, the money will ultimately make up for itself. So each trade that you make is individual of another trade. They're all act differently. You could see the same setup 10 times and they'll all act differently 10 times. Your focus needs to be on that game plan, executing that game plan, managing your trades, focusing on making good trades step by step, one at a time. And if you do that, you don't have to worry about money. The money will be there. If you just do what you know you're supposed to do, how you have been trained or learned or taught or whatever it was, and you know what you're supposed to be doing, things are going to work out for you. And that's what you need to be able to believe in. All right, I want to take a moment to thank you for watching this DVD, and I hope that the materials and the information that we discussed is something you find of value and something that you can implement into your trading immediately to start seeing better results. If nothing else, at least start pointing you in that direction to where you can take the necessary steps to start achieving the type of success that you want. Now, I know for some of you, you're looking for a little bit more in your development as a trader. For those of you that are, I want to invite you to trade with us for 7 days at no cost in our live trade room. Now, one thing about our live trade room, it's probably different than anything that you've seen before. It's not a chat room. It's not an alert service. Everything is done live on screen. We have a whole community of professional traders and regular traders that meet every day. I talk about all of the types of stocks that I'm trading. I have a morning game plan. You see all of my trades, all of my strategies, all of the things that I think about going through the course of each day. You see all of that live play out on screen, whether it's a good trade or it's a bad trade. Every call is made in real time. Every call, you see my entry, you see my exit, you see that all play out. Now, I think that helps you as the trader because it's one thing to see someone's strategy. It's another thing to see how a trader thinks, or to think like an actual professional trader should be thinking. So when I enter a trade, I often walk everyone through what I'm thinking or what it is that I'm seeing, and we discuss targets, we discuss risk, and things change as we talked about the management part. My thoughts and feelings, my emotions change throughout the day about a particular trade. And I'll explain that to everyone in the room in real time. That way you get to see exactly what I'm doing. You get to see what it is that I see, and you get to think the way that I think. Now, I normally do not offer a free trial, but if you're watching this, right there is a link to a 7-day free trial, so you can start trading with us right away. Now, I don't know when you're watching this, or what time this is that you're seeing it. This could expire at any time. I may take this down. I'm not saying that's something that I am going to do, but that's something that may not be available in the future. So if you are watching this, click on the link. If that link is still active, that means the trial is active. So I do invite each and every one of you that are looking to take your trading to another level to come visit us. Come trade with us, see what the strategies that we do, see how we trade, do it 7 days. Doesn't cost you anything, but at least give you an upfront seat on how we approach the market and how we trade the market.
As always, you can visit our website at www.thelincolnlist.com, go to the Education tab, and see some of our other educational materials.
Again, I want to thank each and every one of you for watching this DVD. And if you ever want to reach out to me, don't forget my email is support@thelincolnlist.com. I'll be glad to answer any of your questions. Until the next video, take care. Thanks for watching.